To look more into the details of the Asian markets, we have Bhavik Mehta, Deputy Head Research and Investment Products at Century Financial. Welcome with us, Mr. Bhavik at CNBC Arabia. We will start our interview by asking you what is the current situation when it comes to Davos and where the president of the IMF talked about the Chinese economy and saying that China requires reforms in order to have a better growth in 2024. What are these reforms and what does China need in your opinion?
Well, to start with, what is happening in Asia is we are seeing two sets of divergent themes that is panning out. So on the one side, you have Japan and Indian equities that are really booming past over the last 1.5 year, and on the other side, which is turning out to be very negative, full of doom, we have the Chinese and the Hong Kong equities that are suffering from the past downfalls of the Chinese property and the real estate sector crisis. Now, the talking point in the Davos, as you rightly mentioned, is specifically with regards to the downturn and the pessimism in the Chinese and the Hong Kong equities. So, for China, unfortunately, what has really happened is it is not just suffering from the domestic crisis, but we have also seen, as far as the US-China trade tensions, which is really hampering the overall semiconductor and the chip making scenario in China. So, what really started from the Trump-led trade wars has blown on to be full-fledged conflict between US and China. Now, as far as the structural reforms are concerned, something that has started 3 to 4 years when China implemented tough regulations on the Chinese real estate sector. So we've had more than $170 billion worth of Chinese debt that have defaulted in the Chinese real estate sector. Structurally, unless and until the Chinese leadership doesn't bring it back to the previous reform thing, it's very difficult for the China to come out of this particular thing.
The central bank or the Popular Bank of China seems that they are very keen in cutting the interest rates, and they are not really enthusiastic to do that, and they will not meet the expectations of the markets and cut the interest rates now. Why is that?
Well, in our best guess, the PBOC is waiting for the US Federal Reserve to cut the interest rates, because if you remember, China has already entered the deflation phase. It doesn't want to go into a scenario where it's pumping excess amount of money and again increasing the overall leverage and debt into the system. So what we are seeing is some sort of targeted operations. Like recently, we've had this announcement of 140 to 150 billion dollars worth of special bonds. Then we also had a cut down in the mortgage interest rates to simulate the demand side of the equation. So we will probably see a scenario of interest rate cuts only when the US Fed and the global developed markets start reducing the interest rates.
Mehta Bhavik, Deputy Head Research and Investment Products at Century Financial. Thank you so much for being with us.
Thank you.
Bye bye, sir. Thank you.
Thank you.